Valuation is in the eye of the beholder, or when there's a free and willing buyer and a free and willing seller. So there are a lot of things at play, and why you really need to seek specialist advice before you go to looking at, say, selling a business or buying a business. Hi, I'm Justin Jirwander, a director at Bishop Collins Chartered Accountants. I was a chartered accountant for about 7-8 years. After that, went into venture capital. And the reason why I went to venture capital is I love businesses, and I love seeing businesses operate. I love valuing businesses and finding the valuation of people's hard work. If I were to summarize the different people that would want a valuation of their business, one would be just pure interest, because you're working your guts off and hard for the last 20 years, you want to know what it's worth. 2, you might be looking at some type of succession plan where you want to pass it on to the next generation. The 3rd could be purely from a retirement point of view. And the 4th would be just purely from a profit point of view. You've had enough, you want to move on to something else. So you really need to look at what the reason is, and then from that reason, that'll help you determine the value of your business and the valuation. Understanding the true value is a really tricky position, because true value is, as I said, values in the eye of the beholder. It's what somebody's willing to buy and what somebody's willing to sell. But trying to find as close as possible, or getting an idea of it, is very important for people who want to grow. If they want to grow, the value of a business is what a bank will look at. You want to make sure that your value is as high as possible, obviously, so that you can use that as leverage for the bank to lend you more money to grow. If you want to grow with a merger or an acquisition, that will determine what the terms are of the acquisition or the merger. You know, the true value also from a succession planning helps you determine how you structure that succession into the next generation and how they pay for it. Okay, really good question regarding how a business owner can increase the value of their business now and into the future. Put yourself in the shoes of the buyer. They are looking at something that has lower risk and is sticky. What that means is they want to have a regular, reliable source of income from the business. That's really what the dollars are paid for. So in terms of the value, what a business owner can do is to make their revenue stable and sticky. So that means you need to make sure that the income that you're getting from your clients, they're very loyal to you, they've been around for a long time, there are contracts in place that secure that revenue. You don't have any of these expenses that can come out and be a little bit surprising. The amount of money somebody will pay will be exactly inversely related to the risk. The lower the risk, the higher the return that you will get for your business. The higher the risk of your business, the lower amount you're going to get. Okay, so that's an important part to consider and think about. Reducing risk in the business from the buyer's point of view. If you're a business owner and you've got your financial statements and you're looking at it and wondering, what is it in these financial statements that I could look at to improve the value of my business? It's a very good question. So let's go to the profit and loss. When you look at the sales, that's obviously the major item. So you want to see how you can increase sales. That's a given. The rest on the P&L and the balance on the P&L is your costs. Look at your major costs. Don't spend all your time on trying to save on office expenses. Look at the major cost drivers, which would be your cost of goods sold if you're selling inventory, cost of services, and your wages. In addition to that, there could be rent and there could be delivery costs, but really look at anything that's about 5% of your sales or more. Anything below that is really, you're sort of spending too much time on your effort. In the balance sheet, so the value of a business is very much looking at how efficient the business is. So the things that you would like to look at in a balance sheet to improve the value is your accounts receivable. How quickly are you getting your debts in? How easy is the cash flow? Your accounts payable, how quickly do you pay your debts off? How easily do you turn over your inventory? If your inventory takes, a whole year to turn over, that's a high risk than if I've got inventory that takes, it turns over every month. They're the type of things that you can look at to improve. Now, you need to speak to your financial advisor, your chartered accountant, to then look at those type of metrics to see if you can improve it, because that is a good selling point that reduces the risk of a business and increases the value. Okay, there are many different ways of valuing a business. And the method that you choose if you own the business is obviously the one that you feel can negotiate a higher amount. But the different ways of looking at it, there's basically the net asset position. That's what are the tangible assets less the liabilities. And that gives you a net asset position. And that asset position is arguably the value of the business. Now, the next way of valuing a business is to basically look at the earnings of the business and apply a multiple to that earnings. And that's probably the most common method. So you can use your future maintainable earnings, what you believe your future profit is over the next few years, and then you apply a multiple. So to explain how multiples work, multiples have a relationship to risk. If something is very risky, you will want a very low multiple. So what that means, if I had a $200,000 business income, and I believed it was very risky, I would apply only a multiple of 2, which means the business is only worth $400,000. If it was a very reliable business that I knew I would always get $200,000 for as long as I could foresee, then I might apply a 5 or 6 times multiple. So $200,000 times 5 is $1 million. So you can see that a higher multiple is given to those businesses that are less risky. So to simplify multiples, because it's very complex in terms of its calculations and there's a lot of argument around it. Generally, for a small to medium business, you'd be looking at anywhere from 2 to 4 times multiple, maybe 5 or 6 if it was great. But definitely speak to your chartered accountant like Bishop Collins to help you through that process. Okay, the most common misconception that I find business owners have about their business is that there's only one value of a business and that there is a true value. That is probably the biggest misconception because there is no easy answer to saying there's a true value. If I got 5 valuers in a room to value the same business, they would all be different. And it would depend also on who they're doing it for. So that's probably the biggest misconception around value. The second thing is that I would say a misconception from business owners selling is that they have a personal attachment to their business. So they believe that all of the blood, sweat and tears that they've done is worth a certain amount of money. Now, if that doesn't translate into some type of benefit to the buyer, it's nothing. It's worth nothing to that buyer. The last misconception I would say is that business owners can think that a business owes them money, which is related to the past, but owes them or needs money to retire. Now, you can't expect a buyer to fund your retirement. The buyer is buying the business because it's a good business for them to continue with their journey, not for them to fund your retirement. So get your perspective right before you go into the negotiating table, and it'll help to prevent a lot of disappointment. My strongest advice for people who want to get a value for their business is to one, understand what the purpose of your value is. 2, to understand the perspective of the potential buyer so that you get your understanding of who that is. And 3, then to manage your own expectations. Then your process of going through this will be much easier for yourself, and the process will be much smoother for your professional advisors, being your accountants or your brokers. So the tagline, "You're not alone in business," not only reflects our wish to help people, but it also reflects our acknowledgement that at the top, it is very lonely. Being a business owner, you've got demands from your clients, finding the right staff, increase of costs. And it's important for you to have a mechanism to ask or to bounce ideas off, and that should be your chartered accountant. So you're not alone in business.